Morning, everybody. This is Chris Robinson, Robinson Ag Marketing with today's pre-opening grain and livestock comments for Tuesday, January 27th, 2026. I think the market's going to be watching today in the grains what, if anything, President Trump says when he's in Iowa today. There's rumors abounding about the CZZ, uh, you know, legislation that may be coming down the pike. It should be friendly for corn. You don't want to be in a situation where and it feels like that's what the market's doing here. It's anticipating something friendly. Um, we'll have to wait and see how it all turns out. But that's probably one reason you've seen the rise in bean oil and canola oil as well. Well, two things: China came back and started buying canola from Canada again, but also there's this renewed interest, renewed thought that the biodiesel laws might change and we may get more uniform, consistent demand because that's really what this is. We have an oversupply, and a program like that would be supportive for demand. That's at the end of the day, that's what it is. When you grow 17 billion bushels of corn, you got to have something to do with it besides sit on it. So hopefully it comes true. Overnight, March corn in a whopping 2 cent range. Finished up a penny and a quarter, 429 and a half. I think most people were disappointed in how he backed off yesterday after trying to make more of a recovery post USDA. I think you've got to be worried about it. What happens if we take out 417? We're trading at 427. So there's a dime's worth of risk there to the downside. If 17 fails, it opens the door up to 410, which is the contract low. March beans, another 8 cent range overnight. We'll probably continue to see 8 to 20 cent ranges in beans here as beans try and break out of this range. You don't have to be a rocket scientist to look and see that we're trading in this range 75 to basically 38. We can't get above 75, and we're just kind of waiting for the next shoe to drop in the beans. There's a huge crop coming from South America. The Chinese have bought their 12 million metric tons from us from old crop. Now, exports have been solid. They've been stellar for corn and wheat. Stellar. Part of the reason is the U.S. dollar is lower, and that's another thing. I put it in my letter the past couple weeks, past couple days. The U.S. dollar, if it takes out that low there at just below 96, 95, 85, that's going to be a new 4-year low. You're going to have people screaming about that. So the upside to that is it makes our exports more attractive. So we'll see how that turns out as well. And the wheat overnight, 6 cent range, March wheat was finished in Chicago up 2.25 cents. The risk there continues to be what happens if we take out the contract low? What happens if we have sub $5 wheat? In my weekly wrap, I did do the long-term charts, the continuation charts, and that points out the potential. And again, that's capital potential, capital P. I'm not promising that, but there's a risk to a downside there. There's some old trend lines that go back 20, 22 years that are possible downside targets if we have a 2026 that has a lot of supply and less demand. So on that note, that's what I would say. I would defend. If you're an end user, these are probably great opportunities to get in front of any sort of demand surprise, any sort of weather surprise. Let's face it, it's been a long time since we've had something in 2020 like we had in 2012. And it's been a really long time since we have like an 88 type drought. So we're overdue for that. That would be one thing that would reset the button here to hopefully give us higher prices. Marketing is very hard right now. It's hard to believe that 4 years ago, we had $8 corn and $17 beans. I think that's a lot of the frustration out there right now with a lot of producers. And you have every right to be. But to sit here and say, oh, no, don't worry about it, it can't get any worse, I think that's negligent as well. So if you're sitting on a lot of stored corn, which I think some of you are, there are some extremely cheap hedges, extremely 2.5 cents a month, just to have something out there so you don't get a situation like we had in 2010. And I did send out, that was in my letter yesterday. 2010 was like the last year that makes me feel like this year. We had a very bad USDA report when we slid lower. We didn't go straight down. We actually had a little bit of a rally into May, but we really got hammered from the January high to the June low to the tune of about $1 in corn. Now the June acres report came out, and we also got a little bit of weather, and that set the floor for about a year and a half. We took off and rallied explosively. So it's always the darkest before the dawn. I hope that we can find a bottom here and you'll get these prices higher. But if I'm sitting on a bunch of stored corn, I don't know why I would want a cheap put. And I'll finish on this note. The last USDA report we had, nobody thought we were going to do 18 months worth of prices, which is what we did, 30-cent range. We've been in a 30-cent range for the last 18 months. Nobody thought we were going to do that all in one day. So I certainly didn't. Okay. But we did know that there were some really, really cheap hedges out there. We had 4-cent puts that ended up being worth, 25 cents because they were shorter dated and the market blew up. So you don't have to spend a whole lot of money. Luckily, 10, 12, 15 years ago, yeah, you had to go out and spend 30 cents on a corn put, 50 cents on a bean put, 40 cents on a wheat put. Now with these shorter dated options, you don't have to do that. So don't take my word for it. Educate yourself. But there are some really good opportunities out there to defend your risk, and you don't have to spend an arm or leg. As far as the cattle go, we'll see if we can continue to push higher. There was a pretty good recovery. Fat cattle, feeder cattle all finished higher yesterday. In feeder cattle, if we can get past 365, right? 365 March, that opens up the door to the old gap up there, 370 to 375. Now, again, me pointing out that there's a gap up there, it's not me saying, hey, get long cattle, it's all good. I'm just saying it's a potential target. We've rallied $72 in 9 weeks. I think $72 times 500, that's enough money where even everybody out there, I don't care what sort of protection you get, but I would get some sort of revenue protection to capture a chunk of that $70. Same thing for fat cattle. We rallied $30 in 9 weeks. Don't call a top, but absolutely positively protect that revenue. And there are a lot of strategies out there where you don't have to spend a fortune. So that's it for this morning. This is Chris Robinson, Robinson Ag Marketing. If you need some help, give me a call, 312-638-8868. I put the levels out every day. I try and keep extremely neutral. I don't preach doom and gloom. I don't try to make promises that are just based on smoke and mirrors. I don't know where these prices are going. I have been doing this for 32 years. I did spend 22 years on the floor trading my own account. Was not a broker. Did not have clients. I didn't start working with farmers and producers until 2010 because the floor went away. What I think I can help you do is manage your risk. If you're a farmer or producer, you're always bet long. You're always a bull. You're like the person that would walk into the pit, buy 200 contracts of corn, and then go sit at the bar all day and come back at the close and did I make money or I lose money? Well, with these options out there now, you can have that bet, but you can also have a safety net so you don't get run over if your big long bet doesn't work off, doesn't pay off. So that's what we try to do here. This is Robinson Ag Marketing. Have a great day. Take care.